I'm John Spiridis, SVP of Enterprise Growth here at Vector Alternative Investment Services. We're a premier boutique fund administrator, primarily in the closed-ended space across all asset classes. And I'm joined today by Vardeep Mann, our partner at Weaver. Pleasure to have you, Vardeep.
Thanks, John. Yeah. Hi, everyone. My name is Vardeep Mann. I'm a tax partner here in Weaver's Investment Funds Group. John, pleasure to be here.
Absolutely. Thank you for taking the time today, and I'm looking forward to the discussion. I think, we've done some of these. This is our podcast seminars, and I'm excited to do this one with you. I think, in the past, we've done some basics around tax, around the alternative space. I think today we're looking at both our organizations. We're seeing the life cycle of our funds, primarily we're in the VC and private equity space. So we're seeing a lot of our fund managers, especially with our senior fund group, they've held their clients for a very long time. They're seeing them go from fund one to fund two and fund three. So I guess we want to talk about how you look at things from a tax perspective and what nuances you're seeing as they go through that progression.
Yeah. So, first of all, it's great to see that. It's great to see our clients going from emerging fund managers and going on to raising fund one, fund two, and so on. As far as what changes, I would say is at the emerging stage, tax is kind of a checkbox item. So it's the focus is on just getting it done, keeping costs low, sending K1s on time. Once the fund starts to grow and has a different profile of LPs, institutions, it really becomes part of the fund's operating infrastructure. The institutional LPs, they expect predictability, transparency, and they kind of have their structure in place. So oftentimes they'll send questionnaires and their form of tax estimates. So really, that's that's the shift that we see when the funds are going from smaller emerging manager funds to more with institutional capital.
And we're seeing that as well. We're in the admin space, and we're like the groundwork, right? We're the books and records of the fund before it gets to your team, and we work collaboratively throughout the whole year to manage that process. And we're seeing that as well. We're getting more requests to plan and more requests to outline timelines and put things together year end, and planning into, busy season for all of us. But we're seeing a lot of that, especially as those funds ramp up to those investment classes. I guess also, at what point do you see that happening? So like, there's some trigger points, right? Where do you guys feel is, things that you look for that get you to that next level?
Yeah. Gosh, I feel like as far as kind of what point in time, it's almost like a gradual increase. It's probably a combination of things, from just the fund size increasing, substantially, to, again, the institutions coming into the funds. So your LP profile, the type of transactions. So really what maybe has worked in the past for a smaller fund may not necessarily work for a larger fund with the institutional LPs, whether it's pension funds, endowment funds, offshore investors, big corporations. So it's almost like a combination of things for the later funds.
Yeah, and we see that as well. Our reporting gets a little bit more detailed. We're tracking things at a different level. So working collaborative with you, and you see that as the laws change and all those nuances come into effect, that it impacts the way we do our things as well. So I guess there's some other nuances, right? The fund sizes, things change. You mentioned pension funds. What do you think about the deal activity as well? Is that also you seeing trends in that regard as well?
Yeah. I think just on the deal side, just depending on the deal itself, the investment opportunity, institutions may require you to do a little bit of structuring, whether that's putting an intermediate vehicle in place to, we call it block or protect against certain types of activity flowing up from that deal. So lots of changes that our fund managers aren't necessarily seeing with these earlier funds.
Yeah, we're seeing that as well. So we're doing our books and records. We have to set up those entities. We have to track everything, and we get into certain details and then consolidations. And different nuances. I mean, it's a technology change for us. We have to make changes in that regard, but our teams are just always abreast of those changes and keeping up with them. So it's great to hear. On the LP side, I mean, it's interesting. I've seen a lot of different things. I mean, I've worked in the P space predominantly in my career, and the feeder funds and all those like thousands of LPs coming in. What are you seeing in the VC space? Are you seeing larger funds and smaller commitments? Are you seeing like obviously as they get more institutional, the larger commitments come in? How do you see that trending?
So I think it's a mixed bag. Fundraising was, it was great several years back. So you often saw funds being oversubscribed to and whatnot. Can't say it's been the same, although I think we've turned the corner. It's starting to come back a little bit, but we see the range is so wide between when institutions are coming in. If you're able to get institutional, investors, that's that's a win of on its own. Like you're kind of doing something right to be able to collect checks from institutional investors. But with that, comes more responsibility, more structure around the reporting and the quarterly and the annual information that these institutional investors are required. So, John, if you guys are seeing it on your end, it's only a matter of time before we get in for the compliance on the tax side that they're going to require additional disclosures as well.
Yeah. So what do you think? I mean, we've heard the phrase institutionalized, right? A lot. What does that mean to you? For me, it's always been like, okay, you've got the pension funds. I started off at Credit Suisse where they were all the colleges and all the retirements and all the different, state funds were coming in. What does institutional mean now? Is it different?
Yeah, I mean, I would say it's not a whole lot different than what it was once upon a time. And really it's just, these investors, they have standards, right? They have their internal teams that are looking for, in charge of different things, whether it's deal work, it's compliance, it's reporting. So it's just a different way and a different level of reporting they require. Recently, for instance, the CAMT disclosures came into play. So the institutional investors, the big corporations were sending these information requests out to fund managers saying, hey, can we get this as part of our K1 reporting? And, that's something we plugged into that. So, as far as what that means, it's just, it means consistency. They have their timelines they're looking to meet. So they want, consistency, timely deliverables, tax deliverables, or I'm sure it's the same goes for the quarterly capital account statements on your side, John. And just because everything, there's a lot of stuff feeding into, their own reporting at their levels.
Oh yeah.
So that's why timing is huge. I'd say it's more so just maybe a step up and additional information that fund managers have to, just kind of think through and provide.
We work together on a lot of these clients and we're trying to get the audits done. And then, that fine line between getting the audit done and the requests to get the K1. I mean, if you're in a fund, and I'm not claiming to be a whale or anything, but if you're in a fund, you want that K1, you don't want to delay your tax returns, go on extension. So there's always that timing between getting the audits completed and then your team's trying to get the K1s done as well.
And I think, again, it just varies, right? The earlier funds, you're able to finalize the K1s ahead of the audit. Oftentimes if we was on both sides of it, we're doing the audit work and the tax work, we're able to just kind of, ping our audit team and kind of check in on status and really check in on whether the numbers themselves have been finalized. The audited financials may not need to be issued, but we're able to, once the numbers are finalized, we can go ahead and get going on the tax work to save, or make up for some of that time. And again, for the earlier funds, you're able to almost kind of issue those K1s ahead of the audits being finalized, simply because, I think most of the brain damage happens on the audits with respect to valuations.
Right.
Right. So, and, a number of years ago, the K1s, we kind of went away from that. So we're not presenting on a GAAP basis. It's tax capital and valuations aren't really showing up on investor K1s. So, but with the institutions, that's a kind of project by project. You'll have to think through whether that's okay. And we're able to, issue the K1s ahead of the audit being finalized. So just again, just more to think through.
That's a great point because that is so different, right? That is a behavior modification. So we're the book, so we want to get the audits done, and then but we're trying to juggle all this, and you made a great point. When Weaver's on both ends of that, that makes it easier, right? Less folks in the kitchen, I suppose. Just adding to that, I mean, you've got these family ops investors, angel investors. I guess there's different pressures with them as well as far as the timelines are concerned.
Yeah, yeah. I think, that's usually, that's something that will generally come up around the fundraising, time of, hey, when do you expect K1s to be released? Here in the VC space, 331 is a hot deadline. It's not a statutory deadline,
Hmm.
but it's just a kind of, call it an industry deadline. So we really work towards getting those K1s issued to investors by 331. So what that really means is, I'm sure you guys feel a lot of the same pressure on the book side because
Yeah,
really we can't get started until the financials have been finalized
correct.
and are, and the GPs have signed off on those financials. I'll call it the term, March Madness really applies in our world as well, John.
It does. It
Yeah.
does. Yeah, and it's absolutely the case. And we hit the ground running right after the holidays, and our team here is really efficient at it and has those processes in place where we start to go through our processes and check the boxes with the timelines and get things, by January 1099s. And then you go into February, we're trying to close the books. So we're getting drafts of things and we're juggling the 45 or the 60, every timeline is and then you've got GPs that want more aggressive than the SLAs, right? So we're managing all that as well. So it's really something. There's checkpoints, right? There's things that happen. There's, I suppose, I don't want to use the word trigger, but there's catalysts that you see, visual catalysts that you see, and they get you going, okay, wait a second, now we have to treat this client a little differently. What are some of those things?
Yeah, I think it's probably just, understanding the project. So when we're, going through the planning process, again, we see our fund managers going from fund one and fund two. When fund two comes into play, oftentimes we'll take a look at the LP profile, who's in there. And there's a lot of, common names, household names that we see across funds. So we just to kind of get an idea, and then we'll go ahead and flag some, things we're seeing to our fund managers and say, hey, you're probably going to want to look through X, Y, and Z, and of course, the admin teams, the vector teams are great at getting ahead on a lot of the things that we would normally identify, point out. So it's just a matter of looking at the fund profile, the investments. Are we
Mhm.
seeing non-US investments, and just kind of understanding, are we hitting certain thresholds that require additional reporting, additional disclosure? So um, again, just kind of looking at it from top down, from the fund characteristics, fund profile to the investor profile.
And that's a great point that you made because it's the waterfalls, it's the nuances of some of the side letters, some of the flowing based on different investments coming into play at different stages, and then also what the types of those securities that you mentioned, right? There's debt, debt's a huge, like I worked in credit for 3 years, and that's been an ongoing, I think still the largest asset class in growth. So that's as you mentioned, different controls are in place, different thresholds, different income pickups. I guess that's all part of the what we have to look at for every single client in a different way.
Right.
We tailor our chart of accounts to get the most amount of detail possible. Are you seeing any reporting gaps from when books are seeing, or things that we should be looking out for more or have more scrutiny around?
Um, as far as, I guess, reporting gaps go, I don't know if where, there's a, because typically, the books that we receive from your team, John, are
Yeah,
capturing most of the things ahead of time, which we greatly appreciate. It's more so things that we're identifying on the tax side that may not
right.
necessarily show up on the book side, as it relates to financial statement preparation. Again, we'll see, for instance, we'll scan the SOI if we're seeing limited partnership interests or member interests. We'll kind of go back to the GPs and get clarification on Because say in a typical fund where we see a membership interest in an underlying entity, well, now you kind of lose some of the control over what's coming up to the fund, to your fund, and then ultimately to your investor base. So we want to get ahead of that and to see if there's anything that we need to think through. Do any blockers need to be in place that should have been in place? What kind of activity are we expecting from the underlying fund? Because again, really, it's some of these things can really blow the structure, right? When you're signing on these institutional investors and really any mix of investors, there are certain investors that are very sensitive to certain types of activity, whether it's the tax exempts and the UBTI, and they have to stay within a certain threshold. And so that's a sensitive topic for foreign investors. It's a ECI, effectively connected, income with the trader business in the US. That's a sensitive topic. So really just once we have the initial, set of data to kind of scan through, we'll think through, we'll ask the right questions to make sure that there are no surprises when it comes to year end.
That is a great point because yeah, we're always asking the question of the GP, especially as it gets later in the year when a realization's happening, what the timing of it, is it bleeding over into the next year? Do we have to account for it this year? Trying to get that transparency. So sometimes it's a moving target, but year end is a tough period to close everything because there's no turning back after that.
Right. No, we always tell our clients, let's have the conversation early. We want to get in there as early as we can. Sometimes you're able to kind of fix some issues that would be issues if it's not addressed before year end and whatnot. So it really just depends. So it never hurts. And in fact, it's encouraged to work with your tax advisors really throughout the year. It shouldn't be an annual exercise. It should be, if you're doing a transaction, like, hey, what does this look like? We had a realization. Are there any concerns? Should there be a holdback? Could the GP make it allocated dry income? And so there's tons of things to kind of talk through and look through together with your tax teams and your admin teams. I think it's in the best case scenario, your GPs, your fund admin teams, and your tax teams are all aligned.
100%.
We'll show the auditor some love as well. So really, your accounting teams and your the GPs should all be on the same page, particularly around transactions and structuring. Again, it no longer becomes an annual exercise. It's more so, through the year, these touch points should get more and more frequent.
I think that makes 100% sense. And I think our two teams do a great job of that, meeting and collaborating on that. And our senior members of our team are exceptional because they've been in the business so long. I'm fairly new to the VC, but they've been in the business so long that they're able to, for lack of a better word, advise or work with the GP on structuring. And that's a great point, like how the entities are set up, how allocations are impacted, and foresee, for lack of a better word, challenges that may arise. And that's a big part of, I think, what you're talking about. From a capital account perspective, are you seeing anything like with those different structures? Are there additional things that you're looking for from a standpoint of the capital allocations for each of the partners throughout the life cycle?
Yeah, I mean, really, it's at least on the capital, account side of the house, we're going to cross-check things with the agreement, right? The agreement kind of sets the rules and allocations, and that we want to make sure that everything that's on the accounting and tax side aligns with what the economic deal is. So just kind of checking through and making sure the allocations that are done are permissible under the agreement. Sure, there's always these, call it, one-offs or exceptions to the general rule where the allocation that's supposed to work a certain way, the economic deal, we may not be able to allocate in that way because we're limited by the tax rules. So, and just making sure that, our clients understand why and whether it's a temporary allocation issue or not. So again, just the initial years, or I'll say the initial year, once you're onboarding the fund, that's where you want to make sure you're flipping through the legal agreements, the side letter agreements, and making the proper notes in your working files to make sure that you're staying close to the agreement as not as possible. You should the reporting should be in line with the agreement. It's fairly common, or it's not uncommon to have updated and amended agreements. So you want to make sure
Yeah.
that, we always have the latest agreement on file, and the books and records reflect what the economic deal is.
Yeah, and that's a great point because I've seen it in the VC space more so than private equity. If something happens, we're all in a room for like hours trying to hammer it out. But, from a waterfall perspective, getting the carry count, getting the site, all those different nuances that go throughout the life cycle of the fund year to year, those calculations are super important because that's why they're in this business. So capturing all that and making sure to do it in a way that's transparent for the tax team to pick up and treat appropriately.
Right, right. Because when you're kind of onboarding and you're building out your models and on the tax waterfall, there's book carry, there's tax carry, there's cash carry, right? You want to make sure, just understanding where you are for each one of those buckets. So if there's an amendment to the agreement, you want to make sure your model is adjusted accordingly.
Absolutely. Yeah. I think it's like the theme that we're having here is what do we see? What issues do we not see in fund one that are going to pop up in fund three, so to speak?
Yeah, yeah. It's just making sure you're thinking through everything. I mean, you're thinking through everything on fund one, but fund one, if it's a relatively simple fund and the GPs maybe call it looking to get their feet wet, entering the business, you may have a lot of friends and family. You may have a lot of smaller checks coming in just to it's a proof of concept fund. So I think you may be able to tell your buddy, oh, I'll have your K1 next week. I know I said this week, and your buddy may not mind, but when it comes to institutions, that just hitting your timelines, actually that has a huge impact on your ability to raise or at least get another check from the same institution for a fund three, fund four, or wherever you are in the cycle. So making sure that everybody's on the same page, because we always tell our GPs, you go do what you do best, and that's deal work, right? You're
Right.
out there looking for deals, and you leave the accounting and all of the operations to your teams, to the vectors of the world, to the weavers of the world. And we'll make sure that you're spending your time doing deal work. You're involved as much as you want to be.
Right.
We have some fund managers that are copied on every email back and forth between our teams and yours, John.
Yep.
Right. And
Yep.
there are others that are saying, guys, pull me in when you really need me.
When you need me. Yep.
Right. So it just varies. But I think by the later funds, the GPs themselves have a great understanding of what it really takes to keep those relationships with the institutional investors, and making sure that, on the reporting side, we've got them covered.
Right. Yeah, I agree. And I've seen it different. Each GP is different. We have pretty different levels within our team, but our senior fund controllers and our fund controllers are really good at talking to the team, talking to the GP, getting you folks involved, actually getting legal involved what we need to kind of, go through any nuances that we interpret differently, for lack of a better word, but we want to get to the right answer. And some of those documents can have some nuances to them that we have to iron out. We take a lot of pride in the data we provide to our tax team. How important is that? Can you just, so we can so I can just deliver that message to the team that, yeah, hey, this is the super important aspect of what we do.
Oh, that means everything, John. Really, the data that we receive from our fund admin teams, it really drives the entire tax reporting process, right? Tax is a function of information in, information out, making the appropriate adjustments to books. So if your starting point is off, then your ending point is probably going to be off, right? So super important. And I'll say, I always give the kudos to your teams on the financial reporting side of the house. Just the data that comes our way, it's very easy to work off of. We can
Appreciate that.
see, yeah, we can see different each item and separately stated, and how the allocations are working. And there's internal checks that I always love looking through on just on the financials that your team's doing, and making sure that the models and everything the way it's supposed to be working is working. So the data, again, it's super important, because that's what really drives the entire tax process.
And I appreciate that. And we have that same appreciation for your team, because me personally, when I hear we're working with Weaver, I know what we're going to get. I know the kind of team we're going to be working with collaboratively, and going through that process is much easier. So we appreciate that. Thank you. There's things that happen throughout the life, multiple legs. There's nuances to it. what happens if, those situations arise where we have to make some changes? It's correct. We're book basis. We are capturing taxable events and taxable income. But what happens when we have to make those kind of corrections?
If the books are correct from a book perspective,
Yep.
and you've captured things properly, the tax rules are called independent, right? The tax rules drive the tax reporting. So what works for books may not necessarily work for tax. So that's just a conversation we'll have
Mhm.
with your team, John, and the GPs are looped in on that. For example, if for book purposes you've received some proceeds for an underlying investment, and we're calling it return of capital, so no
Right.
tax implications, right? But from a tax standpoint, we'll have to look through and just kind of do our tax analysis, and it may not be return of capital. It may be a partial sale or a dividend or whatnot. So it really just depends to what the change is going from book to tax, and can we explain it, and do we all understand what the tax implications are for the fund, and for of course the investors of the fund.
And I guess that's great because I think we work very well, but every now and then, there might be something that we have to do a little better. I mean, we all have to a little bit, but,
I have no idea what you're talking about, John.
well, I mean, to your point, I think we've covered it all leading up to this. It's like we have this very robust, very controlled process. And it was amazing to see for such a small firm that we have the checks and balances in place. And then working with you folks and seeing the interaction has just been, um, I worked at larger admins and I didn't see a lot of this. We had a tax team in house. We made a tax advisor in house. We didn't know. And then you're dealing with a larger firm. So this is just more collaborative and much easier to work with. We have PE funds and I have a PE background and we're really making to increase that footprint. We've done a great job in 2025. I have confidence in 2026 is just going to continue. What what the tax complexities are there between maybe this is the tax 101 piece between VC and private equity?
On the reporting side, there are differences, right? Your VC funds tend to just have a different investment profile. The investors can be
Hmm.
there's tons of overlap between the investor base, but as far as the VC goes, oftentimes the VC funds are directly on the cap table, or the form of the investment or the nature of investment is just different, whether it's safes or convertibles or whatnot. On the PE side, the structure could be different, right? There's um, PE funds are, if they're investing into underlying operating flow through entities. What does that mean? How does that change the reporting at the fund level and for our investor base? The PE funds are, typically they're go out and invest in another underlying partnership
Right.
that's an operating partnership or that's operating the business. So there's things like one, trader business income, which your foreign investors would be sensitive to.
Hmm. Awesome.
There's UBTI,
Hmm.
unrelated business taxable income, that which your institutionals call it, your pension funds, your endowments, your tax exempt investors are sensitive to. The allocations, the way the waterfall works, typically there's usually a preferred return for your
Yes.
PE space, 8% or whatever that may be. Generally no preferred in the VC funds. Once the investors receive their cash, their capital, then the rest goes 80/20 or whatever the arrangement is.
Hmm.
So I think there's just more complexity and more things to think through on the PE side than the VC side. I mean, the VC side has its own set of things that we will have to look through, making sure that there aren't any issues, or that we're providing the appropriate disclosures, but they're just different.
It's interesting as initially in the call, we covered the scale up, from fund one to fund two, three, four. That start looking like a more traditional PE type of fund. We still call it VC, but it's turning into a PE type of fund because you've got the different asset classes, you've got more exits, you've got more maybe longer hold periods, et cetera. But it's a great point that you made, and they start to feel the operational pain a little sooner, I guess. What are you seeing there? I know there's different nuances of it. from a tax perspective and from a book perspective. So, defer to you on the tax side.
The PE funds themselves work, are operating differently, right?
Yeah.
There's buyout funds, there's just different types of PE funds, majority owned, whatever the investment, thesis, the profile is. You do, I don't want to say lose, but you hand over some of the compliance things to the underlying fund, right? Really, the underlying K1 that you receive, and of course, a K1, just reflecting your fund's allocable share of the underlying business activity, right? So, although you should, when you're doing the due diligence, the deal work, you should have a pretty good idea of what's coming up, what the business is, and whatnot. But there could be some surprises on the underlying K1, and those are just things that we have to be mindful of, because ultimately that's making its way to our investor base. So you may receive a K1 that where you're operating in additional states. The business is doing well, so you're operating in additional states. Well, that probably means that our fund has filing exposure or filing requirements in those states, and that probably means that our LP base does too, to the extent,
Yes.
there's a whole,
Right.
we can probably do a whole separate podcast on state filings, John, with composite
I'll
and
take you up on
non-composite and withholding and whatnot. So that just means, that again, there are just more data points on the PE side and to think through, and you want to make sure you're getting ahead of it. And in the PE space, it's not uncommon. It's pretty common to send out tax estimates.
Yes.
Right. Whereas on the VC space, the investors have a pretty good idea of what's coming their way, right?
Correct.
They're well aware of
Right.
exits. They're well
That's an
aware of,
excellent point. Yeah.
right. They're well aware of, generally speaking, the capital count statements that, John, your team does a great job at sending quarterly and annually. They're a pretty good idea of what's coming their way on the K1. You can oftentimes strip out the unrealized piece, and you're pretty close to where your tax numbers may be. That's not really the case for PE and then these operating partnerships that you're investing in.
It is different. And yeah, we would always send out tax estimates around the 15th of December. Correct me if I'm wrong. It's around the time when you send out those tax estimates, and then, you're waiting for the K1. So you really can't do anything with those tax estimates, but at least you can forecast and do different things as you prep for tax season. And we've talked about this. We work well together, our teams, and we work with other teams, and you do as well. I guess, at what point do you start to see having separate specialists for different nuances and how some of those challenges can, and we've touched on it a little bit, but maybe we can go a little deeper into that.
I mean, I would just say, just typically the fund size, as you're continuing to increase, you may need specialists in their respective fields. Your LP profile, how's that changing? Your, institutions or corporate investors, family offices, what does that mean from a reporting standpoint? I would say just structuring also, right? If depending on your LP profile, you may need to think through some of the structuring. You have a ton of tax exempt LPs. You're, in a PE fund context, do you need a blocker? You probably do. Whether that's a blocker that the fund manager is taking on. Are you leaving it to the LPs to set up their own blocker and invest through that blocker? So really just, I would say, as you're doing more complex transactions and starting to get into more of the PE side or the just the deal activity is just different in nature, then I would say you probably want to loop in the right parties.
And, we're both, I think, at that point where we're getting into that level, and we're really going to make strides in that level in this year. And it's going to be great to collaborate on those types of engagements and work together on it. I guess, putting my compliance hat on, I'm not compliance officer. Well, do we see any risk associated with that? Like, CFOs are going to do especially with the more mature firms, they're going to do what they want to do. But do we see any risk around that, or, when they're bundling everything up into a single type of provider?
There's probably lots of risks, right?
It's like that. What is it? A SWOT analysis? Like, you have to do,
right. It's probably just making sure that your provider's tax depth matches the fund's complexity.
Right.
Right.
Yeah.
you just want to make sure you have the right teams in play. I guess call it similar to me doing your individual taxes. You probably don't
Mhm.
want that, right? Because I'm at the fund level, the GP, the Manco. So I'm in the investment fund space. So just making sure you have the right party in place, and because your investor base is expecting their K wants to be done right. Because if the expertise isn't there on the tax side, at least that has a whole host of issues for your LP profile, because the way you report certain things, the way things are reported, and which box and the footnote disclosures has real tax implications for the LP profile.
And I think to that point, your team is not in the fund that we're not in the tax space. That's not our business, but we we enjoy working with certain providers, your team being one of them. And up front, I mean, you may want to go to an all-in shop and say, okay, I'm going to save some money, I suppose, or which is always important, especially as a startup. But here you're getting those second set of eyes, which could, I guess, alleviate some risk downstream and put some more, for lack of a better word, checks and balances and things of that nature into play as well. When you kind of create those niches of, okay, Vector in this case is the fund admin, Weaver is the tax, and then we have audit, and then we'll kind of sort all that out.
Yeah, no, absolutely. And look, I think, John, your team and my team, we work a lot with emerging fund managers, to all the way from fund 3, fund 4 to a billion plus in AUM, right? So the
Mhm.
range is very wide. And I think the beauty of that is our teams will go to your teams on the financial side, on the bookkeeping side, if we have any
Yep.
questions, because that's really your lane. That's, you guys are the subject matter experts on something, and vice versa, right? We will jump on the phone with you guys and talk through some of the tax implications of certain things. And as we're recording the transaction, I think going with just specialty service providers, you're getting the best from a quality perspective. You're getting the best product, right? For instance, and I know this is the case for your team, John, where
Mhm.
all the way from your fund accountants all the way up to final review and senior management, you guys specialize in the space.
Right.
You're not doing Vardeep's ice cream shop financials. You're in the space, and the same goes for us. All the way from intern through partner, we exclusively do investment funds, whether it's VCP,
Right.
fund of funds, credit funds, whatever the profile is. So just getting the subject matter experts, you're covered on the compliance side. And if there are questions, there are always questions, right? Our LPs want further clarification, or sometimes they'll come to us for, what does this really mean for us? We're able to get on the phone with the GP, although we're not necessarily providing tax advice. We can give general direction
Right.
to say, hey, this is generally what this means, but you ought to consult with your tax advisor, because we don't have the full visibility into your individual tax situation. So I think just having the right partners on your team can probably, it won't keep you up at night. You're not tossing and turning. Are my K1s going to be timely? Are they going to be done right? Are my
Right.
financials, about done and whatnot? So
And
that's what
and
I'd say.
and that's a great point. And I appreciate that comment from you. Right. And we feel the same way about your team. And I see it all the time. It's different, right? Our senior fund controller, our fund controllers, our team, as you mentioned, front to back, we answer the questions. I mean, we'll get questions from GPs, and they're not easy to answer. You have to have that background, you have to have that experience, and our team, is seasoned in those types of requests.
Yeah, and I mean, I think, John, in today's world, right, everyone knows just enough to be dangerous, right? You
That's
look
a
at
great point. That's a
you
great
look at
point.
the
Yeah.
the chat GPTs, the Groks, the Geminis of the world.
Hmm.
Everyone is using some form of AI, and it's great. I think it's a great starting point, but there are instances where it's not there yet. It will be one day,
Yes.
I have no doubt. But there have been instances of where, and I won't name which platform, where court cases have been made up that don't exist. Code sections have been referenced that don't necessarily exist. So you want to make sure you want to do your homework, but certainly check that by the subject matter experts, whether it's legal, accounting side with your team, or the tax side with ours.
We can do a whole another podcast on AI. So I have strong views on AI, but it is a tool that can be used. And I don't, because maybe I'm an older generation, but as much as others. But I think it's important to get that guide. Sometimes just to get your brain going in that direction, it's important just to get triggered. And then our folks like can just take that and run with it and then look through all the details themselves. So it's an important point you made. As you get into, for our VCs and fund managers or in, PE mid market are looking at this and saying, what boxes do I have to check? How do I know I'm ready to launch? How do I know I'm ready for that next step?
I would say the hardest part is probably collecting those checks, right?
Mhm.
Look, if you,
Excellent point. Yeah.
right,
Probably the
right.
hardest part.
So if you're able to fundraise well and you have the deal flow going, right, you just want to make sure you have the right partners in place.
Mhm.
Because there's going to be a lot that you'll need to spend your time on as a fund manager, primarily on the deal side, going to board meetings and these different investor events and whatnot. So just having the right team in place. I know, John, you mentioned you have a PE background yourself, and
Yeah.
I know there's lots more at Vector that have that same background. So you're now starting to see more PE funds being serviced at Vector. The same goes for us. I myself has spent nearly a decade at a big four firm, working on some of the largest PE funds.
Yeah.
So just making sure you have the right partners in place where in an ideal world as a GP, you're able to hit the forward button to your trusted teams. And, I mean, there's lots of instances where your team and my team is on the same email because the GP
Right.
is saying, guys, can you guys just take care of this for us? And whoever's area falls in and we'll jump in and
Right.
we'll help address. So just making sure you have the right team in place is key.
Yep. That's 100% correct. And it's humbling because for me personally, not the team, like being in PE, you always think, oh, I've TPGs, I've worked at some different places. That's just my career. And you come here and you see the questions that we answer and how we help our clients. And it is really, and collaboratively with you, your teams, it is really awesome. It's really an amazing thing to see how our teams can answer these kinds of questions, because they're nuanced. Everything is nuanced, and it's not like, oh, I've got an offshore feeder. Those are advanced questions that you have to answer, but they get into the stratosphere of, okay, legal and jurisdictions and things. These are nuts and bolts accounting, treatment, and almost advisory type questions that we do, which is amazing. I find it pretty awesome that we do that. I guess to close up here, and we've had a great conversation. I think the best way to close, we're in February now, and what do we see in 2026? Like, what is your team seeing, and what can we expect as well, for lack of a better word?
Tax rules are always changing, right? There's lots that's changed as of late. Luckily for us in our space, John, there's not a whole lot that's making its way into the reporting just
Hmm.
yet, right? Of course, with the OBBA, you have QSBS change was huge, for the better. The industry is able to start taking benefits earlier with the holding period change and whatnot. But as far as what's changed, I'll say this is probably one of them, and I'm sure I'm gonna jinx it here, but
You're
for,
jinxing it.
for 2026, aside from a few additional disclosure requirements, there's not a whole lot that has changed. Again, I'll probably be kicking myself for this later, but I think just when our clients are now bringing in different investor profile institutions and whatnot, it's not just necessarily about being bigger. It's about being more deliberate and making sure that your accounting and your tax teams are in place to be able to address their needs and the disclosures that are required, and
Mhm.
just be a partner. We're of course not a year-end checkbox list at this point. Both
Correct.
your
Yeah, I
teams and
agree.
ours, we're in there throughout the year talking through transactions and advising on the modeling and structuring. And for instance, John, hold on, don't send out all that cash just yet. There may be a
Yeah.
holdback, and there's all kinds of
Yes.
things that come into play. And we're and the earlier we're able to get to those things, the better.
I think what's changing is the fact that we don't know what's changing anymore. Like because of the environment we're in, the factors outside of our industry are impacting. So last year we saw a lot of exits. I don't know if that'll be the same for 2026. I don't think you can tell. It's already February. So, um, geopolitical event, so many nuances that impact the finance industry as a whole, and we're a product of that as well, I suppose.
Yeah, yeah, and I would say, I think, just on the PE side of the house, the funds having a little bit more, more of a voice, more control over maybe the portfolio reporting. There's
Absolutely.
tons that can
Yep.
be done down at the portco level, maybe not necessarily the fund level, but down at the portco level that will ultimately benefit the fund, right? Is the portfolio company leaving incentives and credits on the table that have a real cash impact on the business? The cash savings is of course ultimately going to be distributed up to the stakeholders. There's a lot to think through, and I think having the right teams in place will help identify when to pull in additional subject matter experts
Yep.
into the picture.
Yep. And collaboration, having a relationship like our teams have, and having a relationship with certain law firms and different things. I mean, I think that's huge in this environment. Whereas before it was complex, but it was complex and predictably complex. Here it's almost like, okay, there's different things happening every day. So I think we've covered a lot of topics. As always, we appreciate the Weaver team, and we appreciate you, Vardeep, and this has been an absolute pleasure to have you on and talk through these topics. And tax at the end of the day is it's a big part of this business. What am I paying in taxes after the events and after the real? So we take it very seriously. Our books and our records tying and the quality that we provide, we take it very seriously, and we value. I appreciate your feedback on our team, and we appreciate your team as well.
Absolutely, John. It's a pleasure doing this with you, and I'm looking forward to a successful compliance season, and I'm sure we're going to be talking a whole lot here as we're working through the compliance for 25.
Well, all right, my friend.
Thanks for listening to Off the Books with Vector. We hope you found this episode valuable, and if you did, please subscribe and share with your network. To learn more about how Vector supports fund managers, visit www.vectorais.com. See you next time.